You know that feeling, right? Your business is doing well, revenue's up, profits look good, feels like you're winning.
Yeah, it's a great feeling.
But then maybe this little question creeps in. What's my business actually worth?
Mm.
And sometimes, well, it can give you pause because there can be this surprising gap between those profit numbers and the real value.
That's such a critical point. We see it all the time. Business owners, they're laser focused on revenue, on profit, which is understandable.
Of course.
But they don't always realize they might be leaving, well, quite a bit of potential wealth just sitting there on the table.
Right. And you hear stories, owners get a shock when they look into selling. The valuation isn't what they expected based on the profits.
Exactly. Disappointment is common.
So revenue and profit, they're absolutely vital, no question. But they don't automatically mean high business value.
Not at all.
And that's really what we want to dig into today.
Right.
I came across some interesting stuff that made me think, the real end game for any owner should probably be maximizing that value, not just the profit number on the sheet.
Absolutely. Because let's be honest, for most people who start a business, it's about more than just the money, isn't it?
Yeah, there's usually a bigger why.
There's a vision, right? Serving customers, building something cool, creating jobs, maybe leaving a legacy.
Mm-hmm.
And maximizing the value of the business, well, that's what actually unlocks the potential to really achieve those bigger things. I saw a quote, it was something like, the ultimate goal should be to maximize value, not just profit.
Okay, let's unpack that. Why value? The quote says, value is what someone will pay. So it's not just about today's earnings.
Precisely. Today's profit, think of it like a snapshot. Right now, business value, that's more like looking ahead. It's about the future profitability, how stable those earnings are likely to be. It's about predictability, sustainability. Can this business keep earning and can it grow? That's what a buyer, or even just thinking long-term, really cares about.
So like a business where the owner does everything, even if it makes good money now.
A potential buyer looks at that and sees risk. What happens if the owner leaves? That can really pull the value down, even with strong current profits.
That makes total sense.
Yeah.
Okay, so how do we measure this value thing? I've seen this formula tossed around. Value, recast EBITDA, industry multiple.
Yeah, that's the standard way to look at it.
Let's break that down.
Yeah.
Cast EBITDA. Sounds technical. What is that in plain English?
It's basically trying to find the business's true kind of normalized cash flow. You start with your regular EBITDA earnings before interest, taxes, depreciation, amortization.
Right.
And then you adjust it. You take out things like maybe a big one-off expense you had that won't happen again. Or maybe the owner is paying themselves a salary way higher than the market rate you'd adjust for that. Or sometimes discretionary spending that isn't really essential to run the business day to day.
Like personal travel booked through the company or something.
Could be, yeah. The goal is just to get a clean number that shows the real ongoing earning power. What cash does the business consistently generate?
Got it. A more realistic baseline.
Yeah.
And then you multiply that by the industry multiple. What's that about?
So the multiple, it does two things, really. First, it reflects how attractive businesses in your specific industry generally are to buyers. Some industries just command higher multiples.
Okay.
But crucially, it also reflects the quality of your specific business compared to others in that industry.
Ah, so it's not just the industry average.
No, not at all. It looks at things like how strong is your management team? Are your customers likely to stick around? How efficient are your operations? And really importantly, what's the potential for future growth?
So higher quality businesses get higher multiples.
Exactly. Things like, really well-documented processes, a leadership team that could run things without the owner needing to be there every second. That stuff boosts the multiple.
Okay, now this is where I think a lot of owners might miss a trick. I read that people often focus like crazy on boosting revenue and cutting costs, driving up that EBITDA number.
Yeah, makes sense. You want higher profit.
But they maybe neglect these other things, these value drivers that push up the multiple.
That's a super common pitfall.
So they end up with decent profits, maybe, but the multiple is low because the business isn't seen as high quality in those other ways. And boom, disappointing valuation. Or maybe they can't even sell it easily.
Precisely. They've built something that makes money, yes, but maybe it's not as transferable or as de-risked as it could be for a buyer.
Yeah.
And the risk there, the consequence of not actively building that value, well, one source put it quite starkly, you risk someone else reaping the rewards of the potential you built.
Oof, that's a tough one to swallow. Imagine spending decades building something.
Yeah.
only to sell it for less than it could have been worth. Maybe you struggle to sell it at all, and then someone new comes in, tidies up the processes, builds the team.
And suddenly unlocks all that value that was latent there. They benefit from your foundation.
Yeah, ouch.
And there was another good point made. Businesses with higher value are more sustainable. Which makes sense, right? They're better run.
Mm-hmm.
This helps ensure that the work you have done over decades can continue to thrive with new owners or a new generation of leadership.
Mm-hmm.
So thinking about value, it's not just about selling someday, it's about building something stronger, more enduring.
Okay, so how do we actually do that? How do we shift from just chasing this month's profit to actively building that long-term sustainable value? I saw that idea of value creation engines. What are they?
Think of them as the key levers in your business. When you pull these levers effectively, you don't just increase profit, the EBITDA part, you also improve the quality of the business, which drives up that multiple. There are 4 main engines.
All right, let's go through them. First up, revenue growth. Okay, that seems pretty straightforward. Get more customers, sell more to existing ones. How does that hit both EBITDA and the multiple?
Well, the EBITDA link is obvious, right? More sales generally means more profit, assuming your margins hold up.
Sure.
But for the multiple, strong, consistent revenue growth is really attractive. It tells a buyer, hey, the market wants this. This business has momentum. There's potential here. It signals lower risk and future opportunity.
Okay, makes sense. Demonstrates demand. What's the second engine?
Process optimization. This is about documenting, streamlining, and improving how everything gets done in the business, the internal workings.
The behind-the-scenes stuff. How does tidying up processes boost value? Seems less glamorous than revenue growth.
Maybe less glamorous, but hugely important. Better processes usually mean lower costs, less waste, more efficiency that boosts your EBITDA directly.
Right, saves money.
But the multiple impact, huge.
Yeah.
Clear, repeatable processes that don't rely entirely on the owner's brain. That makes the business predictable, scalable, less risky. A buyer sees a machine that can run and grow even with new leadership. That's incredibly valuable.
Gotcha. Predictability and scalability.
Yep.
Okay, number 3, culture development. Building an engaged, aligned team. I get how a good team makes work nicer and maybe more productive day to day.
Definitely.
But how does culture translate into hard dollars for evaluation?
Well, a strong, positive culture usually leads to higher productivity, less employee churn. Both of those save money and boost efficiency, hitting your EBITDA.
Okay, tangible benefits there.
But again, think about the multiple. A buyer looking at a business with a great team and a strong culture sees sustainability. They see leadership depth. They see a business that isn't just dependent on the founder. It signals that the company can keep performing even after the sale.
Right.
Reduces that key person risk.
Right. The team can carry it forward. Makes sense. And the last one, strategic innovation.
Yeah, this is about looking ahead. Developing new products, new services, maybe finding new markets, staying ahead of the curve.
This feels very future-focused.
It is. New offerings can create whole new revenue streams, obviously boosting EBITDA potential. But from a multiple perspective, it shows the business is adaptable, it's forward-thinking, it's not going to just sit there and become obsolete. It signals future growth potential and maybe even market leadership. Buyers pay a premium for that future story.
Wow. Okay, so each of these engines, revenue growth, process optimization, culture, innovation, they don't just help profits now, they actively make the business itself more attractive, more solid, more valuable.
Exactly. They boost both the quantity of profit, EBITDA, and the quality of that profit, the multiple.
And it really hit me reading about this. The time to start thinking about this stuff isn't like 6 months before you want to retire.
Oh, definitely not. That's way too late. Often.
Yeah, there was a stat, something like over half of business exits are unplanned.
That's the figure often quoted, yeah. Life happens. Health issues, family changes, market shifts, partnership disputes. Things can force your hand unexpectedly.
And if you haven't been deliberately building value all along, you could be forced to sell at a bad time or for a much lower price than you could have gotten. You basically lose out on potentially years of hard work just because you weren't prepared.
It's a huge risk, leaving significant money, maybe life-changing money, on the table.
So the message is really clear. Don't wait. Don't wait until you think you're ready to sell. Start building value now. The best time was yesterday.
And the second best time is today. It really needs a mindset shift, doesn't it? Away from just the monthly P&L towards building a valuable asset.
Totally. Okay, so let's try and tie this all together. The big takeaway seems to be revenue and profit. Super important, obviously. but they're not the whole story.
Not by a long shot.
Maximizing the actual value of the business, that should be the real goal. It's better for a potential sale down the road, sure, but it also just makes for a stronger, more sustainable, maybe more impactful business right now.
Couldn't agree more.
And the way to do that is by focusing on those 4 engines. Growing revenue smartly, optimizing processes, building a great culture, and innovating strategically.
And remembering they all connect, you know. A great culture helps with process optimization because people are engaged. Better processes free up time for innovation. It all works together.
Right, it's a holistic thing. So maybe the question for everyone listening is, thinking about your business right now, what's one thing, just one step you could take today to start intentionally building more sustainable value, even if selling feels miles away?
That's a great question to ponder. And for anyone who's curious about where they stand right now, you know, what their business might be worth and what the potential could be, one of the resources we looked at mentioned a site.
Oh, yeah.
It's measure.valuecreationengines.com. Apparently, they offer a free confidential valuation consultation. Could be a good starting point for people to just get a baseline and see which engines maybe need the most attention.
Good resource. Measure.valuecreationengines.com. Definitely worth checking out if you want to get serious about maximizing the value of all that hard work.